What's up, guys? It's Tom here, and today I want to share how you can make $3,000 a month by investing in dividend stocks. Because let's be honest, wouldn't we all love a life where money wasn't a constant worry? Imagine waking up every morning knowing your investments are working for you, and instead of your paycheck, your account gets a nice boost from dividends rolling in. This isn't some far off fantasy. This is something we can all achieve even if you're starting later in life. So in this video, I'm going to walk you through 3 straightforward strategies to create a steady stream of dividend income, enough to make $3,000 a month or $36,000 a year without having to take on crazy risks. You just need a solid plan. So first, let's quickly cover what dividends are. When you invest in a company by buying its stock, you become part owner of that business. When the company makes a profit, they have a choice. They can reinvest it to grow the business or share a portion of it with their shareholders, which is you. That's your dividend. Dividends are usually paid out as cash every few months, and some companies even offer the option to reinvest your dividends to buy more shares. Now, the beauty of this system is that you can earn regular income without selling your investments. So over time, it's like building a financial snowball that grows and pays you more and more. Now, the key to dividends is the dividend yield, which measures how much income you earn from dividends compared to the stock price. For example, if a stock costs you $100 and pays $10 a year in dividends, the yield is 10%. The dividend yield can vary from company to company and can either be cut if the company is going through rough economic times, or the company can periodically increase their dividend if they are financially doing well. So understanding dividend yield can help you evaluate investments. You can compare stock prices and make smart decisions based on your goals and comfort level with risk. So the goal is to invest in companies or funds that pay reliable dividends, giving you steady cash flow without having to sell off your shares. That's how we'll aim for $3,000 a month. So let's jump into the first strategy, which is covered call ETFs. One of the fastest ways to build up dividend income is with covered call ETFs. These funds are a bit unique because they combine stock ownership with options trading. Investors can earn income from both the stock appreciation and the dividend payments. So here's how it works. The ETF owns a basket of stocks and writes call options on those stocks to generate additional income. Call options give buyers the right, but not the obligation, to buy a stock at a specific price within a certain time frame. When the ETF sells call options, it receives premium income, and that income gets passed along to investors like you in the form of higher dividends. Covered call ETFs often have double-digit yields, which means you can earn more income with less money invested. Some popular covered call ETFs include RYLD, the Russell 2000 covered call ETF with a yield at 12.28%, and QYLD, the NASDAQ 100 covered call ETF, which at the time of this video has a yield of 11.61%. Now let's look at the math. To earn $3,000 a month or $36,000 a year with covered call ETFs, you'd need to invest around $300,000 to $320,000. Compare that to the usual $2 million you'd need with traditional stocks, and it's a massive difference. Now, like any other investment, these ETFs aren't without risks. Yes, they can provide a steady income stream with a lower initial investment, but to me, the biggest risk before going into these is that covered call ETFs give up some of the upside of the market in exchange for additional current income. They can be a great strategy to create income, but a lot of people don't understand there's a trade-off here. If the S&P 500 index was up 15% for the year, a covered call ETF might only be up 7%, but you've been collecting the income along the entire time. So I can see a covered call ETF strategy making up a portion of your overall portfolio, focus on solely producing income rather than being your entire investment strategy. It can be an effective way to generate consistent income without requiring millions in capital to invest. The second strategy is investing in real estate investment trusts, otherwise known as REITs. If you're interested in real estate, this can be another attractive option. A REIT trades just like a stock and owns or manages income-producing properties. So think shopping malls, office buildings, or apartment complexes, and REITs are legally required to pay out 90% of their profits as dividends to the investors. So I like to think of REITs as investing in real estate, but without the headaches. You don't have to go out and buy a physical building on your own or deal with tenants or have to lock up your money in a physical property. REITs allow you to participate in the real estate market without having to own a physical piece of land or property, and at the same time still maintain access to your money. Some examples of REITs to illustrate this concept include Seven Hills Realty Trust with a yield of 10.76% and Arbor Realty Trust with a yield of 11.08%. So to reach $3,000 a month with REITs paying around these yields, you'd need to invest about $340,000. Not too far off from what we were investing in covered call ETFs. But one of the bonuses to investing in REITs is many pay dividends monthly, which is perfect for creating steady cash flow. So overall, I think REITs can be a great addition to a diversified portfolio to add additional income. If you look back historically, REITs have delivered solid returns. But as you can see, some years REITs lagged behind the S&P 500, like in 2023, with the S&P getting almost double the return of all equity REITs, and over the past 5 years, the S&P getting 5% more in return. But again, at the same time with REITs, you are collecting the income the entire time, so there's that trade-off. REITs also have risks tied to what's happening in the real estate market. So for example, real estate can be very sensitive to changes in interest rates, which affect property values. Also, in order to maintain the expected payouts, they must maintain certain occupancy levels. So like any other investment, do your research and make sure you're diversified. And finally, there's investing in Dividend Aristocrats. This, in my opinion, might be the best way to go if you're looking for stability. These are S&P 500 companies that have increased their dividend payouts every year for at least 25 consecutive years. They are known for their reliability and steady growth. So think of household names like AT&T, T. Rowe Price, or Franklin Resources, which offer yields averaging around 5%. Dividend Aristocrats tend to have lower yields than covered call ETFs or REITs, but they're incredibly reliable. These are well-established companies with a proven track record of not only making it through tough economic times, but some of the companies actually increase their dividend while going through some of these tough economic environments, which honestly is a good sign for stability in the company. Now let's look at the math here. To earn $3,000 a month with Dividend Aristocrats, you'd need to invest roughly $720,000. While that's more than the other strategies, the trade-off is rock-solid consistency with a 25-year track record. Plus, you can spread out your investments across multiple stocks on the list to diversify yourself, reduce risk, and create consistent income. So whether you choose covered call ETFs, high-yield REITs, or Dividend Aristocrats, there's a path for everyone to live off dividends and enjoy financial freedom. Thanks everybody. I appreciate you watching. Hit that subscribe button if you liked the video, and I will see you in the next one.